can't really fail at investing unless you choose the wrong stock or get excited at the wrong time. Allow me to offer some perspective on how you might think about investments, rather than focusing on what's happening today or even this minute. Let me take you back in time to March 12, 1942, when the New York Times headlines were filled with bad news from the Pacific. The United States had just entered a war that we were losing at that point. Despite the negative headlines, I was watching a stock called City Service Preferred Stock, which had sold at $84 the previous year and was now down to $40. That night, I asked my dad to buy me 3 shares the next day, which was all the capital I had accumulated up until then. The next day, the stock market took a nosedive, with the Dow Jones Industrials breaking 100 on the downside, equivalent to a 500-point drop today. My dad bought my 3 shares right away in the morning, so I paid the highest price for the day. By the end of the day, the stock was down to $37, which was quite characteristic of my timing in stocks that would reappear in future years. The key takeaway here is that investing requires a long-term perspective and the ability to remain calm during market fluctuations. It's essential not to let short-term headlines or momentary panic dictate your investment decisions. However, this stock was on the New York Curb Exchange, which later became the American Stock Exchange. Even though the war was ongoing and looked bleak until the Battle of Midway, this stock performed quite well. I bought it at $38.25, and eventually, it was called by the City Service Company for over $200 a share. But this isn't a happy story, because I sold it too early, making only $5 profit. Again, typical of my behavior at that time. Now let's imagine you were back in March 11, 1942, with uncertainty in both the European and Pacific theaters. Everyone in the United States knew America would win the war, and the American system had been working well since 1776. Imagine that at that time, you had invested $10,000 in an S&P 500 index fund. Without changing the slide, think about how much that $10,000 would be worth now if you held onto it throughout your lifetime, basing your decision on the output of the investment. Don't change the slide yet. Now that you have a number in mind, let's reveal the answer. You would have $51 million. To achieve this, you wouldn't have had to do much. You wouldn't need to understand accounting, look at stock quotes daily, or listen to others' advice. All you had to do was believe that America would do well over time. And if America did well, American businesses would do well too. You didn't need to pick winning stocks or the right time. You just had to make one investment decision in your life. And that wasn't the only time to do it. I could choose other times that would result in even greater gains, but the key takeaway is to focus on how American businesses will perform throughout your investing lifetime. Let's consider another scenario. Suppose you had taken that $10,000, listened to pessimists, and bought gold instead. With your $10,000, you could have bought around 300 ounces of gold. While businesses were reinvesting in more plants and innovations, you would visit your safe deposit box every year to see your 300 ounces of gold. You could admire it, touch it, but it wouldn't produce anything. Today, you would still have 300 ounces of gold worth around $400,000. If you had chosen a non-productive asset like gold over a productive one that reinvested earnings, paid dividends, and grew in value, you would now have over 100 times less value. For every dollar made in American businesses, you would have gained less than a penny by buying gold, a store of value people often turn to when scared by headlines. It's remarkable that we've had such a tailwind in this country, making it an investor's paradise. You can't truly fail unless you buy the wrong stock or get excited at the wrong time. If you owned a diverse range of American businesses and invested consistently, there's no comparison to owning non-productive assets like gold. There's also no comparison to trying to time the market or paying investment advisors. Following this retrospective advice, your stockbroker might have gone hungry, and you could have attended their funeral as consolation. But you would have fared better than a significant percentage of investment professionals or those trying to time the market. It's difficult to beat the results achieved with a relaxed philosophy. You don't need extensive knowledge of accounting, stock market jargon, or predictions of the Fed's next move. None of that matters in a lifetime of investing. What matters is sticking to a philosophy you understand and avoiding activities you're not knowledgeable in. Thanks for watching.